Welcome to the deep dive. We've got quite a stack of material today, really pulling back the curtain on what some very influential investors have been up to. You know how it is, right? Earnings season, big filing deadlines. The amount of data is just huge.
It really is. Almost overwhelming sometimes.
Yeah, and it's so easy to miss something important, something hiding in plain sight.
Exactly. And, speaking of important data, that May 15th deadline we just passed, it's actually pretty critical.
Oh, are you talking about the 13F filings? Yeah.
That's the one where all the big institutional managers, the ones handling over $100 million, have to show their hands, reveal their holdings to the SEC.
Right. It's our quarterly peek inside their portfolios, what they were buying, what they were selling last quarter.
It's like getting, well, maybe not their whole playbook, but certainly a few key pages.
Definitely. And look, we always mention the caveat, the data's backward looking. Could be 45 days old.
Yeah, not real-time trading.
But it's still super valuable for spotting trends, seeing where the big bets were being placed.
Absolutely. You see which stocks are getting attention, which ones are falling out of favor with that, smart money.
And while everyone, understandably, focuses on Warren Buffett's moves.
Always big news there.
There are other billionaire managers making really significant changes that maybe don't get the same splashy headlines, but tell us a lot.
That's right. And that's actually what grabbed our attention this time.
Oh, what was it?
Well, there was this pretty surprising move involving a couple of well-known billionaire fund managers.
Yeah.
They were selling down their stakes quite significantly, actually, in a stock that's famous for being a sensational stock split stock.
Huh. A stock split stock, one that's done really well long term.
Phenomenally well since its IPO. Massive returns. So, yeah, selling it seemed unexpected, especially before the split happened.
Okay, that does sound counterintuitive. So that's our mission today.
Exactly. Let's unpack this. We need to understand what a stock split really is first. Maybe quickly cover that.
Good idea. Then introduce the company, who these sellers are.
Dig into why they might have sold.
But also, crucially, explore why they might end up regretting that decision. Sound good?
Sounds like a plan. So, stock splits. To understand why selling before one is interesting, we need to be clear on what they are.
Right. So break it down for us. What is a stock split?
Okay, basically it's just a company adjusting its share price and the number of shares out there by the same factor.
So like a 2-for-1 split. You suddenly have twice the shares, but each one's worth half.
Precisely. Your total ownership value stays exactly the same.
So it doesn't actually change the company's market cap or how well the business is doing?
Not one bit. It's purely cosmetic. Think of it like getting 2 nickels for a dime, more coins, same value.
Got it. Just slicing the pie into more pieces.
That's a great way to put it. And there are 2 main types, really.
Okay.
You've got your forward split, which is what we just described. Price goes down, share count goes up. Companies often do this when their stock price gets high, maybe to make it seem more accessible. It's generally seen positively.
Sign of success?
Maybe. Often, yeah. Leading companies tend to do them. Then there's the opposite, the reverse stock split.
Let me guess. Price goes up, share count goes down.
You got it. And that's usually, less positive. Often done by struggling companies trying to boost their share price, maybe to avoid getting kicked off an exchange.
Right, so investors usually don't like seeing those. But forward splits, the market tends to rally around those.
Generally, yes. It's seen as a sign of confidence from management. Which brings us neatly to the company at the heart of this, Fastenal.
Fastenal, ticker FAST. What's their business?
They're a huge wholesale distributor. Think industrial supplies, construction supplies, nuts, bolts, safety equipment, tools, all the essential stuff businesses need to build things and keep things running.
Okay, the unglamorous but vital stuff. And their track record, you said it was good.
Good is an understatement. Since they went public back in 1987, their total return, including dividends, is over 214,000%.
Whoa. Okay, 214,000%. That's a true compounder.
Absolutely, a multi-decade winner. And they're definitely familiar with stock splits.
How so?
Well, this recent split they did, a 2-for-1 completed on May 21st. That was their 9th split since their IPO.
9th. In 37 years.
Wow. Yeah, roughly 1 every 4 years or so. The sources point out they're one of only 3 really preeminent businesses that announced or did forward splits since early 2025. O'Reilly Automotive and Interactive Brokers were the others mentioned.
Okay, so Fastenal, massive long-term winner, frequent splitter, just did number 9, generally seen as a positive signal. You'd think big investors would be holding on tight, maybe even buying more into the split.
That's the logical thinking, isn't it?
Yeah.
But these 13F filings covering the first quarter ending in March, They showed something else.
What?
Before Fastenal even announced this latest split, two prominent billionaire managers were cutting back significantly.
Okay, now we're getting to the juicy part. Who are we talking about, and how much did they sell?
All right, first is Cliff Asness at AQR Capital Management. His fund oversaw the sale of, about 519,000 shares of Fastenal.
519,000 shares. How big a chunk of their stake was that?
It was about a third. One-third of AQR's position in Fastenal gone.
A third? Okay, that's not insignificant. And the second manager?
Izzy Englander at Millennium Management.
Millennium. Right. What did they do?
They dumped around 203,000 shares.
And for Millennium, how much was that?
That was almost 3/4 of their entire stake in Fastenal.
3/4?
Yeah. Now, quick note, Millennium does a lot of hedging with options, and they had options positions here too. But looking just at the common stock, they sold off nearly 75% of it.
Selling a third. Selling almost 3/4 of a stock like Fastenal before its 9th split. That definitely raises eyebrows. What could possibly be the thinking there?
Well, let's consider the possibilities. One obvious one, especially for these kinds of highly active funds, is just taking profits.
Right. After a 214,000% run over the decades, there must be huge gains baked in.
Exactly. Asness and Englander run funds that aren't exactly buy and hold forever types. They're active. Locking in profits after a massive run is just, prudent portfolio management for them.
Makes total sense. Take some chips off the table, as they say. What else?
The other likely culprit is valuation. Fastenal stock has done incredibly well, but that means its price tag relative to earnings has gone up too. The source material highlights its forward price-to-earnings ratio, the PE ratio looking at expected earnings. It's sitting around 35.
And how does that compare historically for Fastenal? Is 35 high?
It's about a 16% premium compared to its average forward PE over the last 5 years. So, yeah, it's trading richer than its own recent history.
Okay, so not crazy bubble territory, but definitely not cheap compared to its own track record.
Right. So these managers might have just looked at it and thought, okay, great company, but the price has gotten a bit ahead of itself. Time to trim.
So profit-taking and valuation concerns seems logical enough for active managers.
Yeah.
But you mentioned there's a strong case they might regret selling. Why?
Yeah, because those reasons focus on maybe shorter-term stuff, like the current valuation multiple or just locking in past gains. But when you look at Fastenal's core business, there are some really powerful long-term strengths.
Okay, like what?
Well, first, their business is just deeply, deeply tied to the economy, particularly the U.S. economy, but globally, too.
Right. Industrial activity, construction. When the economy's humming, they sell more stuff.
Exactly. And think about economic cycles. Yes, we have recessions. They're unavoidable. But since World War II, recessions have only lasted about 10 months on average.
Okay.
Periods of economic expansion, on the other hand, they've lasted roughly 5 years on average since 1945. Much, much longer.
Ah, I see where you're going.
Fastenal just grows right alongside that expanding economy. So betting against Fastenal long-term is kind of like betting against the economy itself continuing to grow over time, which historically hasn't been a great bet.
That's a really strong point for the long view. What's the other fundamental strength?
This one might be even more important, actually. It's about their customer relationships.
How so?
They've really invested in becoming more than just a supplier. They offer managed inventory solutions. You know those industrial vending machines or bins you sometimes see on factory floors or construction sites?
Yeah, stocked with gloves, fasteners, tools.
Exactly. Fastenal often manages those right on site for their big industrial and construction clients. They're internet connected, they track usage.
So it saves the client time and hassle having supplies right there.
Huge savings for the client. Less downtime, optimized inventory. But the key thing for Fastenal, it makes the relationship incredibly sticky.
Sticky, meaning hard for the customer to switch away.
Precisely. Once Fastenal is managing your on-site inventory, providing that essential stuff seamlessly, you're deeply integrated. They're not just selling you bolts, they're part of your workflow, your operations.
And they learn a lot about the customer's needs that way, I bet.
Absolutely. The sources say the bulk of Fastenal sales come from these kinds of close-knit integrated relationships. It creates a really powerful competitive advantage, a moat around their business.
Okay, so we've got this real tension here. On one side, you have smart, experienced billionaire managers looking at maybe a stretched valuation and massive past profits, deciding to sell. Rational, perhaps, from their perspective.
Right, based on shorter-term signals or portfolio needs.
But on the other side, you have these deep fundamentals. a business tied to long-term economic growth and these incredibly sticky, integrated customer relationships that are hard to replicate.
Exactly. It's a classic clash between maybe market timing or valuation sensitivity and long-term business quality.
So for you listening in, what's the takeaway? I mean, it really highlights a few things, doesn't it?
I think so. First, just because a big name sells doesn't automatically mean it's the right move for everyone or even for the long term. Smart money disagrees all the time.
Yeah, they have different goals, different time horizons, active trading versus long-term investing.
Right. And second, context is everything with data like 13Fs. You can't just see sold and assume the worst. Was it profit-taking, valuation, hedging? You need to think about the why.
Definitely. And maybe the biggest point is understanding the actual business, how it makes money, its connection to the economy, its competitive advantages, like those sticky customer relationships for Fastenal.
Sometimes those fundamental long-term drivers can really outweigh short-term market noise or valuation blips,
It really underscores that investing isn't about finding one magic signal, but weighing different factors, understanding the core story.
Well said.
Okay, so just to recap quickly, we dove into why it was surprising to see billionaire managers like Cliff Asness and Izzy Englander selling big chunks of Fastenal stock before its recent ninth stop split.
We looked at the logical reasons, huge profits to lock in, maybe some valuation concerns with the stock trading at a premium to its history.
Whether we contrasted that with Fastenal's powerful underlying strengths. It's linked to the economic cycle, which historically favors long growth periods, and crucially, those deep integrated customer relationships built through things like on-site inventory management.
Which really embed Fastenal within its clients' operations.
Right. Which leaves us, and you, with a final thought to chew on.
If Fastenal's success is fundamentally driven by that long economic runway and those incredibly sticky, hard to disrupt customer ties,
Yeah.
how much should short-term factors like valuation fluctuations or the portfolio adjustments of active traders really matter when you're thinking about where this company might be in, say, 3 years, 5 years, or even longer?
Yeah. Does that deep-seated business strength potentially overshadow the shorter-term trading signals we just saw? Something to consider.